Hi, Chapter 1, Upstream Oil and Gas Operations. In oil and gas operations, there's different classifications. There's the upstream, which is exploration, acquisition, drilling, developing, and producing. Our class is going to focus on the upstream activities. There's also downstream, refining, processing, marketing, and distribution, such as gas stations. And the midstream, both the upstream and downstream activities are classified as the midstream. There's different accounting treatments for the different areas of oil and gas operations. An oil and gas company can be either integrated or independent. If it's integrated, it's involved in exploration and production and at least one downstream activity. An independent oil and gas company is only involved in the exploration and production activities. This is a short video on the formation of oil and gas. There's different steps involved in finding oil and gas. First, there's going to be the geological and geophysical studies to identify an area of interest. This is going to be a large or broad area, such as aerial studies or seismic studies. Second, you would obtain a lease from the person who owns the mineral rights. Third, there would be detailed geological and geophysical studies, maybe a smaller area, more seismic studies, and they would be analyzed. Fourth would be to drill the well and obtain the data. And fifth would be to complete the well if it's economically feasible, or if not, to abandon the well. There's different mineral rights that we're going to talk about, and these are the right to share in the proceeds from the sale of production from the property. So first, there's just identified a mineral interest. You may have a royalty interest or a working interest. You can have an overriding royalty interest, which is a non-working interest created from the working interest. A production payment interest, which is a non-working interest created from the working interest. It's limited to a specific amount of oil and gas, either money or time. And you might have a net profits interest, which for onshore would be a non-working interest created from the working interest, or offshore if a government retains when the leasing blocks. So we're going to discuss the different interests and how they're developed. So first we're going to talk about the royalty and working interests. So royalty interest is the interest retained by the owner of the mineral rights when the property is leased by a company. Typically it's 1/8. You may see something different. It's considered a non-working interest, which means it does not share in the costs for exploration, development, or production. Once you do have production, however, it does pay its share of the production tax. The working interest is the person or company who leases the property from the mineral interest owner. So it's created from a lease. They're responsible for 100% of exploration, development, and production costs. It also shares in its revenue after deducting the royalty interest. For example, if Mr. A owns the mineral rights to the property and he leases the property to Company B, but he retains a 1/8 interest, so he would have a 1/8 royalty interest. The remainder, 7/8, would go to Company B. In addition, Company B would pay 100% of the costs, which would be his working interest. There may also be an overriding royalty interest. If the working interest owner decides to lease the working interest to another party, and he may keep an overriding royalty interest. He no longer pays any exploration, development, or production costs. He just has the overriding royalty interest in the revenue. So taking our example, Mr. A had the mineral rights and leased the property to Company B. After that transaction, Mr. A has a royalty interest and Company B has a working interest. Then if Company B decides to transfer the working interest to Company C, Mr. A still has his royalty interest. Company B now has an overriding royalty interest, no longer shares in the cost, so he no longer has a working interest, and Company C would have the working interest. If we want to look at the percentages, if A leases to B, retaining a 1/8 royalty, and B conveys that interest to C, retaining a 1/7 overriding royalty interest, on the costs, 100% will be paid by Company C, who has the working interest. For the revenue, Mr. A still has his 1/8 royalty interest. Of the remainder 7/8, Company B retained 1/7, so we would multiply the 1/7 times the 7/8, and Company C would have the 6/7, remainder of the 7/8. I mentioned different mineral interests that may occur. So if you have a production payment interest, a non-working interest created from the working interest, limited to a specified amount of oil, gas, money, or time, or you may have a net profits interest, onshore, non-working interest created from the working interest, or offshore if the government retains the lease. So the lease is actually the legal document that states the terms of the transaction. So these are the basic provisions that you might see in a lease. So you would have a lease bonus. This is something that's going to be paid to the mineral rights owner for the right to explore, drill, and produce on the property. There's going to be a royalty provision. It's going to say how much royalty is to be paid to the lessor, the mineral rights owner. There's going to be a primary term, the time to begin drilling, and then it will provide for delay rental payments. This is a yearly payment that's paid on the anniversary of the lease if there is not any drilling or production operations. If a well is to be drilled, there would also be a drilling contract. This will be between the working interest owners and a drilling contractor. It may be structured in different ways. You may have a day rate that's based on the number of days drilled, a footage rate that's based on the number of feet drilled, or turnkey, which is a fixed sum based on drilling to a certain depth or stage of completion. There's different types of wells. You have the conventional well shown on the very left. You may have a directional well if you cannot do the vertical well like you're in an urban area. And this can also be used offshore for multiple wells with one platform. And you may have a horizontal well which exposes more of the reservoir. Now you're going to incur exploration and drilling costs, but at the point where you need to make the decision whether to complete the well or not, those are considered sunk costs. They are costs in the past and they cannot be changed. So when you're looking at the decision whether to complete the well or not, you're going to be comparing the incremental costs to be incurred versus the net cash flows from the sale of products. Again, it does not consider the sunk costs prior to drilling, such as the exploration. And there's different methods for recovery. You may have primary, which is pumping, and it's produced from the natural pressure. You may have secondary, which is water flooding, for example, to recover additional oil. And you may have tertiary, which is enhanced recovery, could be including the injection of chemicals, gas, or heat. So that concludes the slides for Chapter 1.